live here with Mitch Friedman with Pivot Lending Group. Um, Frequently, right, I'm coming here Facebook Live to interview industry partners, find out, the ins and outs of our real estate world, right? Because there's a lot of moving parts, and oftentimes we get so many questions about different things that want to make sure we're going to the source to get the right information. So Mitch with Pivot Lending Group has been as one of our preferred lending partners for quite some time, and a fantastic partner here for our Keller Williams Avenues office that now officially has two locations. We're in Old Town Arvada and in Westminster, just off of 92nd Sheridan.
Congratulations on your new space.
Well, thanks. It's still coming together. We got a lot of work to do here, but yeah. So, Mitch, as you and I were talking about what we wanted to convey today, my question was, what are some of the frequent questions that you're getting right now? What does that look like for you? And it came up around mortgage insurance. So, before we dive too far into the mortgage insurance, introduce yourself real quick for those who don't know Mitch, and tell those watching what they need to know about Mitch.
Excellent. Well, I appreciate it. Thank you for inviting me again today. I always love joining you and talking about industry standards and ways to help our buyer clients purchase a home with strategic opportunities that maybe they haven't thought about or known that exist. And so I'm Mitch Friedman. I work at Pivot Lending Group. We're a local mortgage banker, which means we're a direct lender. We're out of Littleton, Colorado. And we facilitate the loan all the way from taking an application through the day of closing. We're not a mortgage broker, so we don't send out any information to other companies to get the loan approved. And this is my 30th year of doing home loans in the state of Colorado, so very well versed in all the different communities. I know a lot of real estate community to help, which we'll talk about in our conversation, to actually help an offer possibly get accepted when there are multiple offers being reviewed by a listing agent and their sellers.
Gosh, that's never happening in this market, is it?
No, it's very random these days, but we've been able to navigate through that and try to jumpstart getting our clients' offers accepted through really good, valid conversation.
Well, and the reputation of the buyer's agent and the lender and the inspector, all of those things play a factor into getting an offer accepted. So with Mitch and the reputation you have, which is an impeccable, phenomenal relationship and reputation for getting offers accepted, right? Because people know how Mitch is going to perform. That's helping a lot of your clients right now in this competitive market.
Correct. And it really starts with getting on the phone when an offer is presented by you for your buyer client. And I just educate the listing agent, letting them know what the benefits are of our client's offer, how we'll make sure we get to closing on time, and how that we'll communicate with them during the transaction and all the other benefits that come along with the type of offer you've made. And oftentimes I'll know the listing agent, and when we know each other, or they'll know you, Matt, when they know us, they know our reputation, they know we'll perform and close on time with as little hiccups along the way. And if there are hiccups, they know that we'll communicate that right away. And that way there's no surprises prior to the close date. And sometimes knowing everybody at the time of the offer would allow that offer to get accepted if it's a competitive offer with other offers that are very similar. So reputation is everything in our industry. And we, as you and I do, we protect that with everything we can, because that's really what we have to provide to our clients.
Yeah, without a doubt, it's super important. So, Mitch, let's talk about mortgage insurance, right? First of all, what is mortgage insurance, and why is it that people need to be aware of what it is and maybe what it isn't?
Sure. So we're going to talk today about that, and then also a strategy to help eliminate the need for mortgage insurance as well. But mortgage insurance was created many, many years ago, back in the 1950s, actually, which people don't think it has gone back that far, but it has. And what mortgage insurance is like any other insurance policy, and that is it protects the lender that if the buyer is unable to make their monthly mortgage payments for a certain amount of time, that property can result in what's called a foreclosure. And when there's a foreclosure, the lender takes back the property, but also doesn't have any money coming in to make the payments that were agreed upon by the buyer. So there's many companies out there who provide insurance or mortgage insurance coverage to the lender, not to the buyer. A lot of times buyers think that insurance coverage is for them if they can't make their mortgage payment. And that does exist. That's a different insurance policy. So that when the lender is confronted with a foreclosure, the mortgage insurance companies will step in and give the lending company anywhere from 12% of the loan balance up to 35% of the loan balance. And so if somebody were to borrow $400,000, didn't make their payment on time or couldn't make their payments anymore, and it went to foreclosure, the lender could get up to 35% of that amount, or that's $125,000, $130,000 right off the top from the mortgage insurance company.
Wow.
Because of that, that allows the lender to make loans with smaller down payments because they have that kind of coverage. So even though they're only doing 3% down payment, if you subtract out the 35% mortgage insurance that they're getting coverage on, it's actually like a 38% equity position for the lender. And that's why they're willing to make small down payment loans, because of that protection.
And not a bad setup there for the lender, right? Because unlike my auto insurance, somebody else is paying for this on behalf of the lender.
Correct, exactly. To offset the risk of having a small down payment.
Yeah. So there's a benefit, right, to the buyer,
It's
because
a win-win
without
for
it,
both sides.
right,
Sure, it's a
they
win-win.
wouldn't have it, right? There's a purpose there for it. As all of these loans, right, lending institutions are assessing risk. If I lend out money, what's the risk that it's going to go away and never come back, or what's the likelihood I'm going to get paid back? So,
Correct.
so I appreciate the description there on mortgage insurance. So let's talk about the traditional way that most people would think about avoiding mortgage insurance.
Sure. So the most common known way is by applying a 20% down payment when somebody's buying a house right out at the very beginning, and using a conventional loan. So those conventional loans are Fannie Mae loans or Freddie Mac loans. They're the two common conventional loan programs. And their guidelines say if the buyer puts a 20% down payment, they do not have to be charged or have coverage of mortgage insurance. And what's interesting about that is over the years, how mortgage insurance can be avoided to be paid without putting a 20% down payment. And there's a lot of different strategies, or a couple strategies really, to work with, and we'll talk about one. But that's what most people know, is you got to apply a 20% down payment.
So is buyers, or maybe first-time home buyers, are new to buying and they've not gone through that path of a low down payment to 3.5%, 5%, whatever that looks like. You still get this question frequently. Oh, I don't have 20% to put down on a home.
Correct. And many people think they must put 20% down, to your point, in order to actually buy a home. And in reality, there are many programs that require no down payment, where they can get support from a down payment assistance program. They will pay mortgage insurance on that program. Or they could put 3% down on a traditional Fannie Mae loan, or 3.5% down on an FHA loan, Federal Housing Administration. So the 20% requirement is not a requirement to actually buy a home and borrow money and get financing for buying that home, outside of having to put 20% down. But there will be a cost of mortgage insurance in some of those examples.
Yeah. So, for those that are watching that don't have the 20% down, don't want to pay the mortgage insurance, and can't blame them, right? When we bought our last home, wanted to make sure we put enough down to avoid the mortgage insurance. So what are some programs, some availability to avoid that extra cost? And how much is that cost oftentimes? I mean, what are we typically looking at?
Yeah, that's a really good question, because it varies based on the initial down payment that the buyer would put towards buying the home. So when you put a smaller down payment, the cost of mortgage insurance will be more expensive. And when you put a larger down payment that's less than 20% down, for example, let's say it's 15% down, the cost of that mortgage insurance is lower because they're applying more than 3% down. So it's a greater down payment, which equates to lower risk to the lender. So they charge less money. So the mortgage insurance, let's say on a $400,000 loan, would range from something like $200 a month if they were putting 3% down to maybe $60 a month if they were putting 15% down. And that's assuming good credit scores and a few other items. So it's much smaller with the larger down payment. But even so, $200 a month is a lot of money. And if we can avoid having our buyer pay that, and even though if they could afford it, they could use that money towards a higher purchase price to be able to buy the home they really want, maybe. That's what one of our strategies we're going to talk about today will be.
Yeah, and even for some of those, if they don't want to increase their purchase price, they could take the $200 a month they would have been paying and put that towards their equity, build equity a little bit faster, or pay
down other debt.
I'm not advocating like going out and getting more debt, right, to get another $200 a month payment covered. Right. But you have that advantage. So let's talk about one of those programs. Tell me about kind of that first one that comes up and its benefits to the home buyer.
Great. So one of the strategies, one of the strategies we have is where we break up a loan that would initially be, let's use the example of a 10% down payment, that somebody would have to pay mortgage insurance. And so if somebody were to, let's say, buy a $500,000 home, $500,000 home, and they put a 10% down payment, that would be $50,000. That is better than having to put 20% down, which would be $100,000. And so right there, they save $50,000 required to come out of pocket with. And then what we do is we present a second mortgage for the same amount of 10%, which would be $50,000 in that example. And the first mortgage would make up the difference, which is 80% of the value of that property. So 80% of $500,000 property would be a $400,000 first mortgage. They would have a $50,000 second mortgage, and they would apply a $50,000 down payment. That's the structure of that loan. Because that first mortgage is at 80% of the value of the property, it appears as if there's a 20% down payment from the very beginning. So the lender, which would in this case be Fannie Mae, does not require mortgage insurance to be paid because they're not loaning 90% of the home, they're only loaning 80% of the home value. And so that's the very, very simple strategy of how they avoid paying mortgage insurance by applying only 10% down instead of 20% down. But there's a lot of other significant strategies around that loan program that helps a lot of different buyers in different scenarios. One of them could be if they were trying to sell or have another home to sell, and they don't have that 20% or all the funds they need for the larger down payment until they sell their home, but they don't want to sell their home as contingent upon buying the next home. Mm-hmm. So meaning they don't have to sell their home in order to make an offer to buy the next home and be able to purchase it without selling their existing home. They can just apply 10% down, and then when they sell their home, take all the equity from their home that they would have gotten and apply that towards paying off that second mortgage that they took out when they originally bought the home they wanted prior to selling their current home. So it's a way to eliminate contingencies. It's a way to eliminate mortgage insurance in that example. And if they would have had mortgage insurance in that example, it would have had to remain on the property for 2 years at a minimum. At a minimum. So even if they sold their home and had all this money and applied it towards the down payment or reduction of their existing loan on the new home they bought, and they were paying mortgage insurance, even though they would put at least more than 20% into it, they still had to pay mortgage insurance for 2 years because they didn't put 20% down when they bought the home.
Yeah, or if they went to refinance that house, right? They sold the current house, right? They've refinanced the second house when it's sold to try to get, unless the rates were that much better, you've got closing costs and some other things associated with it. It's still going to be less financially advantageous than breaking it up this way.
Well, correct. And you bring up a good point, even when we do this strategy, and that is, let's say when they sell their existing home, they had $100,000 to work with, and they took 50 to pay off the second that they took out when they bought the new home, and they have 50 that they want to apply towards reducing the balance on their first mortgage. They can do that, and they could have their monthly payments reduced to the new lower loan amount without having to refinance.
Wow.
And that's it's called a recasting of the loan.
Yeah.
So it even invites that opportunity as well.
What's interesting and fascinating with all of this to me is there are so many ways that we can attack this, both before and after kind of the transactions are going along, as long as we have an open dialogue with that mortgage professional. One of the reasons why I don't get into the mortgage industry, Mitch, you've got 30 plus years of experience in mortgage than me. You're way ahead of it. You study it every day. I want to be great at what I do, and I want to go to the resource so that Mitch can actually walk somebody through on how to do it. For me, I just want to know enough to say, hey, you need to go talk to Mitch, right? Have the conversation. Let's talk to Mitch, because if there's an objective if there's a goal, well, let's talk to Mitch and see how we accomplish it. Don't just think because, gosh, it doesn't fit in this box, it doesn't work.
Right. And it's very true. There's so many different opportunities and strategies that are available to people that they're just not aware of, because they don't buy homes or finance homes very frequently during their lifetime. And things change from 5, 10, 20 years ago, that maybe when a new home loan was taken out at that time. The current options available have changed for sure. And they become a little more creative, a little bit more user-friendly to the client who needs the financing to help save them money, and to open up other possibilities of using their money in the best way possible, so that they're not necessarily dumping all their cash in, let's say, into a home loan, or maybe they could use some funds to buy a rental property instead of applying all their money for a down payment on a primary residence. Yeah. Or buying one rental property, they might be able to buy 2 rental properties because they didn't know you only needed a certain amount of money for down payment. So there's a lot of really progressive ideas and opportunities and programs that I have available to me within my company to share with our buyer clients and prospective clients who are just looking to get what we call pre-approved, to know what their options and choices are. And usually they walk away saying, I had no idea I could do all those different things. The good news is they can do many things. Sometimes the challenge is, how do you pick from all those different things that meets their comfort level and their budget and things like that. And I do help advise what I think based on their time frame. For example, if they say, when I find a home, I think I might live in it for 5 to 10 years, that's a different strategy of loan program selection than if they say, I think I might only be here for 2 years. So we navigate together. We build a partnership like you do with them, and all 3 of us build our team and partnership together. And we work through the choices that work best for them and make sure we're looking out for their best interest.
Well, and I'm not going to name drop as far as bashing anybody on my Facebook Live here right now, but one of the challenges that we're going to see and that we see in our industry, the big box banks, the national lenders that have such a large pool of employees who are just looking at, okay, does it check this box? Does it check that box? Okay, follow this. If we can't follow that, then we can't get it done. That's one of the challenges that we see with those big advertisement companies that are pushing out the information, or those big box banks, because they just don't have, it's not that they don't have the resources, but typically their loan officers don't have the bandwidth to understand all the little nuances and get creative the same way that Mitch has the opportunity. So, and if you're watching this video, the question you should be asking your lender is, hey, it's not, hey, what are your rates? Right? That's a very basic question. And for the most part, you're going to find rates are going to be competitive across lenders. It's not
Correct.
the rates that make the big difference. It's the fees, it's the programs, it's the tools, the resources. How creative can they be to make sure that you accomplish your objective with buying this home, and it costs the least amount of money out of your pocket to be able to do it, and making sure that it gets done.
Correct. And that's something that we again feel like separates us, because we have a lot of different programs available to us than a banking loan officer might have. And our industry is so nimble, knowing the marketplace, and we know we have to be fully available and move very, very rapidly in the industry. And part of that nimbleness is saying, here's plan A, plan B, and plan C. What works best for your scenario? And then truly, and I talk about this all the time, that we also need to have a backup plan.
Mm-hmm.
So if plan A or B doesn't work for whatever reason, do we have plan C so we can still get to closing with a really good loan program that our buyer client already knew about was a fallback option should we have needed one. So a lot of different things go into the strategies around buying a home and financing it. And then once you make some decisions, making sure those strategies will continue down the path. And if they don't, that you have an alternative strategy so that they can still buy the house.
Yeah, and you got to love the optimists, with just their vision that everything's going to work out just fine. And we have to also really love the skeptic that says, okay, yeah, we're going to hope everything goes well, and we're going to look for what might not go well, right? Because I've got to plan for those contingencies and have something in place versus, getting 75% down this road and figuring out, gosh, we were on the wrong road. We could have made a pivot at, just step 2 that would have gotten us there a whole lot easier.
Correct. And that comes with, one, having availability of different programs, but 2, being able to foresee kind of the future of what a client's scenario is, and doing this as long as you and I have both been doing it. When I hear certain things in my conversations, I have a pretty good idea where that's going to end up. And so what we do is we make sure we get the right data up front, given those scenarios, to say, okay, sounds like you're going to be doing this. We need to make sure we have the proper documentation for that. And if we can get that, we're in good shape. But if we can't, here's the alternative to that.
Yeah.
So.
Love it. Right. You and I are very much in alignment. We're going to be a little bit skeptical and say, okay, it's great if it's going to work down this path. Let's look for what might not, and how do we make the adjustments and pivot as we need. So let's talk about some other options for avoiding mortgage insurance that you have access to, or some resources, some tools around.
Yeah. So another solution is, and I don't want to say it's avoiding it. It's kind of strategically maneuvering some of the numbers around to where we as the lender can actually build the cost of the mortgage insurance into the mortgage rate, of which then there's no separate monthly mortgage insurance payment. And the benefit of doing that strategy is it will fit into a scenario where a buyer says, hey, I'm only going to be in my house for 1 to 3 years. And we say, then we're better off rolling either the cost of the mortgage insurance, where we can pay it all up front in one fee to avoid a mortgage insurance payment on a monthly basis, but we, the lender, can pay that fee for you. And the way we're allowed to pay that fee is by increasing the interest rate a little bit. And sometimes it's about 0.25%. But that fee is lower, that rate is lower than the client paying a monthly mortgage insurance payment for those first 2 or 3 or 4 years, or even more, while they own the home. And it's a way to negate having to pay that as a separate payment. And it gives a lower monthly payment and allows them to have a greater capacity, should they need it, to qualify for the home they really want to buy. And so
yeah, right.
Yeah.
So what this looks like, right? And I'm going to use myself as an example. It's say I'm purchasing a home and I got approved at 3.5%, but a scenario where I'm going to need to pay mortgage insurance. we can go up to say 375, which is still a fantastic rate. I don't have the separate mortgage insurance, which has increased my monthly budget significantly more, right? And
Correct.
okay, so my payment's a little bit higher over the course of 30 years. Over the course of 30 years, that might be a less advantageous way to do it, right? Because there's a bigger cost there.
Correct.
But if I'm there for 3 years, I spent a whole lot less in that 1/4%. And that's why I'm a firm believer. The lowest interest rate is not always the best deal. You got to take a look at the entire picture. So,
Correct.
right, spend a little bit more on your mortgage, have no mortgage insurance, so your overall payment's less, and you end up coming out ahead.
Correct. And your mortgage your mortgage interest is tax deductible, where mortgage insurance is no longer tax deductible. That went away about 6-7 years ago. And you don't also have the same analysis and review of mortgage insurance coverage from a standpoint of qualifying. So, and mortgage insurance eventually could go away if you were making monthly payments.
Mm-hmm.
But if you put, let's say, a 5 or 10% down payment, it could take anywhere from 7 to 12 years for that mortgage insurance to fall off. So it really is a significant savings. Again, in the shorter term, being 0 to 5 or 6 or 7 years, if you're going to think you're going to own the home for about that time frame. And every strategy is unique to the client. It's got to work for them, and that may not be the best strategy for them. Then we say, okay, then just pay the monthly mortgage insurance, and let's talk about, after you are paying it, how can we get you out of it? Because if you can prove you have 20% equity at some point down the line with a new appraisal, you could request to have it removed. So there's so many different opportunities around mortgage insurance, in addition to around all the different program selections, that there's so much to know and so many things to pick from. My job, as I get hired, is to help advise and narrow down the selections that seem to fit the need of our clients.
Yeah, and the strategic partnerships and the conversations, the ongoing conversations, for those that are watching. So, hypothetical scenario, right? You bought your house 3 years ago. You've been paying on mortgage insurance. Now, here's a gift of how the market's kind of gone for us. You may have 20% equity today where you didn't have it 3 years ago. And maybe it wasn't put down 18%, now I'm at 20%.
Right.
It might have been, I put down 10%, or in some cases, I put down 5%, and maybe I'm there, depending on how the appreciation went. You can absolutely reach out to me and we can talk through, does the market bear? Do we think you have that number to get that dropped off? Because mortgage insurance, sometimes it falls off automatically, right, Mitch? And sometimes
once you reach a 22% equity position,
yeah,
from your original loan amount and your current loan balance, your original purchase price and your
right,
current loan balance.
So your original purchase price doesn't go up every
Correct.
year like your
That
equity.
is correct.
So you got to get to that 22% of that number, which can take a whole lot longer, because
Right.
it's just your purchase, your monthly payments, right? The little bit, especially early on, that goes to your equity, right? Knocking that down to 22%. So, right, there's a lot of folks watching this. You may be in a position to just get out of mortgage insurance today by kind of making a phone call or a couple of phone calls.
Correct. Yeah, definitely. We were talking about, you made a comment about the market conditions and values going up. One strategy around the marketplace and trying to be aggressive, if you do currently own a home and or not, and you're buying a new home, and there's a term that's been used for a while now called the appraisal gap. And the appraisal gap, if you want to explain it, you can, but I'll kind of tie in the loan side of how do you support the price you and the seller have agreed to pay for and what the appraised value ultimately comes in at. And if the two don't line up together, the difference between the appraised value and your purchase price is called the appraisal gap. And that dollar amount in the gap must be paid for with cash from the buyer, dollar for dollar, in addition to the down payment. And where I'm going with all this is if someone said, I'm going to put a 20% down payment to avoid mortgage insurance, and everything is looking good until the appraisal comes back, and we find that there's a $25,000 or $30,000 difference between the purchase price and the appraisal, all of a sudden that buyer may not have 20% down anymore, because now they have to use $25,000 to make up for the appraisal gap. And why I'm bringing this up is that ties back into that initial loan where we do the first and second loan, to where the borrower can still avoid paying mortgage insurance by putting 10 or 12 or 14% down. It doesn't have to just be 10%, it could be more, to avoid paying mortgage insurance, even though they had to use some of their 20% down payment to make up the appraisal gap. But they were able to make it work and still buy the home they wanted, knowing going in that there might be an appraisal gap, because they had to be aggressive on their offer. But this would still allow them to avoid paying mortgage insurance.
Yeah, so might be to their advantage, instead of 20% to put down 10%, at least on the contract, showing that, hey, we've got the ability to cover this appraisal gap if we need to. If the appraisal comes in at a good number, they're still putting the 20% down they fully intended to, and things still kind of work out to that advantage. Then layering on top of that, Mitch's strategy, wow, we could really line ourselves up to be in a much better spot, both financially after the home and on the front end of it when we go to purchase the property, when the sellers are looking at 2, 3, 4 offers that are all very comparable. What's going to be the kicker? What's going to make the difference?
Correct. And that's where our conversation with the listing agent comes in to say, and I get this question all the time from the realtor who's representing the sellers, does your buyer have the capacity to come in with the difference of that appraised value and the purchase price? Should it not come in, can they do that? And the answer would be and again, I'm going to caveat, with the authorization of our buyer, I would be able to respond to say, yes, we do. We have plenty of funds to work with. And so that helps them better navigate through our offer and maybe move that to the top of the list, where possibly other buyers don't have that capacity, or they're not thinking about other strategies like this one to free up some of that cash to be used towards the appraisal gap.
Yeah. Well, and right, just for a CYA, your disclaimer, right, for both Mitch and I, we're not advocating that you pay more than a property's worth, yet certain scenarios where things are going, that may be what it takes to get that particular property purchased. Just depends on how much you love that property. There will always be other homes coming on the market, right? That might be the scenario that particular home and that you might need to go down to get that home purchased. So again, when we look at tools in the toolbox, let's fill the toolbox full of the best tools, and then you as the buyer or you as the seller get to have the discussion and then choose what are the best tools, what are the best resources to get done what you need to get done.
Right. Correct. And market conditions change. So we're in that market condition now where there are people who are being very aggressive in their offers to try to buy the home that they want to buy because there's less inventory available. And, if we do this same conversation 3 and 4 months from now, the market may be different, where we may say now it's become a different market, and here's another strategy that helps protect our buyers. Because our goal ultimately, to your point, is protect our buyers' interests and make sure they're being looked over, and looked upon to get the best transaction possible with the best financing should they need financing. And what can we help to offer them to help them win a bid should they decide that's the house they want to buy? Yeah. With the current market climate being a seller's market. That's the caveat there.
Yeah, if somebody's watching this video and it's not 8/18/21 when they're watching it, the market may be very different, right. And it'll take a different strategy at that time. So right. Again, reaching out to Mitch, reaching out to me, and we'll talk through strategy and is that the game that ultimately a buyer or seller wants to play?
Correct. Yep.
Cool. Anything else? I think we've covered 3. And if I remember correctly, you mentioned there are 4 different things to cover, or did I make
Yes.
that number up?
You did not make that number up. There were 4. 3 is a normal thing in our minds, but 4 is actually accurate in this case. And again, going back to the first and second loan conversation, or part of this conversation in the loan strategy, is that if somebody does own their own home, and they don't even have to own a home, but if they do, and they sell, and they don't want to sell the home first before they buy the new home, so the non-contingent offer, when they ultimately sell their home, and I think we did touch on this, but I'll reiterate it, they can use those funds to pay off that second mortgage. So that second mortgage payment goes away automatically, and they don't have to worry about continuing to pay on it, but they still were able to get a loan without mortgage insurance. Whereas if they did one loan at 90%, and if they just put the 10% down and didn't do the second mortgage, not only would they be stuck in that mortgage insurance, but then they have all this extra money to work with. Where do they apply it to get rid of a certain payment? They'd have to go in and do the recasting of that first mortgage. So it's a little cleaner after the fact. It also works if somebody doesn't own a home, where they say, look, I just want a first and second mortgage. I don't want to pay mortgage insurance. And I get bonuses all the time, and I'm going to use my bonus money to pay that second down very quickly. And I don't want to have to worry about refinancing, to your previous point about that. It's another strategy, same loan, same strategy to help that scenario where people get lump sums of money, and their goal would be to apply towards their mortgage and pay it off sooner. So it's another way to utilize that. So it's got great potential for many different scenarios, and it's something that we came up with. It's actually, that second loan is unique to Pivot Lending Group because we are the servicing company, so people pay us directly. And the reason why it's unique is that the interest rate on that second mortgage is the same interest rate that they'll get on the first mortgage. And it is a 30-year principal and interest payment on that second mortgage, but that second mortgage is only fixed for the first 5 years. It then converts to what's called a 1-year adjustable rate mortgage, which is another conversation, but it does give a 60 payments, 5 years worth of never changing on the interest rate at the lowest rate possible, like the first mortgages. And that is very unique to our industry. Nobody else has that program. So
yeah, very unique. Normally, right, second mortgages have come with a little bit higher interest rate, and having the ability to do that again, it's a tool in that toolbox, especially for the first 5 years to keep that same payment. That's fantastic. Right now, for a lot of those that are watching, understand, right, that 5 years is going to come to an end. Understand that, right, you have to have a plan in place to do something different, have it paid off, or be okay with the fact that you're going to have a 1-year adjustable rate, just kind of moving forward. Just don't let these things catch you by surprise, right? Mitch is going to lay it all out on the front end of it. But
that's correct. And we do full disclosure. Yeah. Everybody understands what they're getting into when it happens.
Yeah.
Usually this strategy, again, is for people who are going to pay that second off quicker than 5 years. That's why it works really well for a couple of the items that we talked about today. But if it does stay on there longer, it is the most conservative adjustable rate loan after those first 5 years, should it adjust. But that is a dialogue I have with each client and making sure they fully understand what we're talking about. So I don't want them calling me saying, you never told me.
Without a doubt, believe that, and I've experienced that, right, Mitch, as you've been a fantastic resource for a lot of my clients. Yes. Mitch does a phenomenal job walking through. Right, people tend to forget things, right? All of a sudden it's 5 years later and oh, I forgot that was coming up. It's there, right? Just make sure that, let's put a plan in place, put a Google Calendar or an iPhone calendar reminder about 4 years out or whatever that looks like.
And actually,
so
I do that myself for my clients who use that program so that they don't forget, number one. And number two, we look at, does it look like it might make sense to possibly refinance and roll that loan into a new first loan, because they may have 20% equity at that time. So it doesn't just go away and forgotten about on my end. That is part of my service and my commitment to my clients.
Well, one of the reasons why, again, I love working with Mitch, right? Because you think about those details, you understand human nature, and our likelihood to forget, right, as a consumer. So
Yes. Well,
being out in front of folks to make sure that we don't
I'm really
forget.
good at I'm really good at planning for my clients. I'm not as good as planning for myself. So I'm there for them and less there for myself.
You need your own Mitch Friedman to be
I
out in front of, yeah.
Yes, exactly. So it's a good reminder when I do. I'm like, I bet I have something just like this.
Right.
Yeah.
Yeah.
So
Yeah, very good. Right. It goes back to that. We're always good at giving advice for other folks, but not always great at following our own advice. Right. I know I should exercise.
yeah,
It doesn't mean I always do it.
I was the last person to refinance because I was too busy refinancing my own clients. And I
Well,
got an earful from my wife.
yeah, should be an easy slam dunk for you.
And exactly. So
Um, cool. Well, as we wrap up that conversation, anything else just around mortgage insurance at a high level, right?
mhm.
That you want to part with as we kind of wrap up.
Yeah, don't be afraid of it. Know that it exists, and know that there's some strategies around how to work around either eliminating it or getting it to the lowest cost possible given each individual's unique scenario on buying a new home. And make sure you hire someone like myself who knows how to work through those different options given the scenario. And then from there, you can make the best decision. But it's not bad. People think mortgage insurance is a bad thing and want to avoid it at all costs. It actually is a good thing because it's allowed people to put a smaller down payment and still get to buy a home. And if it didn't exist, we would be at 20% down still as a minimum down payment. And I can tell you at least half of my transactions monthly are people putting far less than 20% down. So it's something that exists, but we need to just know how to work with it and understand it and realize that it may not be as expensive as you think it is.
Yeah. Right. Let
Yeah.
let the system work with you,
Yep.
and let Mitch understand the system, right, so that he can guide you along those lines. So,
Exactly.
cool. As we're coming up to the end of summer, and I know we've still got some time before summer. Any kind of big summer end of year plans? Have you got anything to kind of wrap out this summertime?
Well, I just got back from Hawaii. I was there for 2 weeks. And I've never taken a 2 week vacation ever. So that was kind of interesting. It was like two vacations in one. So that was the big to do. I may head to San Diego at the end of October to do a last hurrah there. And no, other than that, looking forward to getting back out on the tennis court and all this smoke clearing up from the air so we can play outdoors and exercise outdoors.
Yeah, probably a little bit easier to do the exercise when you were in Hawaii, away from all that smoke.
It was spectacular. I know why people like to go there. I don't know if I could live there, but I sure enjoyed being there.
Now,
A little different pace.
Did you catch some big fish?
Yeah, it was this big. I did some snorkeling, and that's as much fishing as I did. There were a lot of sea turtles that were amazing to watch and kind of trail as they were swimming around.
Yeah.
So that was pretty fun, and just warm blue water, and it's amazing that you can actually work sitting in a lounge chair with your feet in the water and respond to emails and make sure everybody's taken care of, and they have no idea where you're at in that moment.
Well,
That's what we do.
Great on that end of it.
That is what we do.
Mitch, I've got your email address down here at the bottom.
Appreciate
Mitch
that.
at thefriedmangroup.net.
Yep.
If you've got specific questions that are lender specific, make sure you reach out to Mitch. He's always happy to be a resource for information to talk through. Obviously, if you've got more real estate specific questions, you guys know how to get a hold of me. So again, Mitch, thank you. And thank you in advance. Mitch has agreed to kind of a regular reoccurring monthly video as we talk about mortgages and how it impacts real estate. So the questions that you have as you're looking through these videos, watching these videos about mortgages, let us know what you want Mitch and I to discuss, and we'll make sure we hit that. So
definitely. Great. Well, thank you again, Matt, for having me on. It's always good to get together, and look forward to our next meeting next month. And hopefully you'll get some end of the summer vacation in too. What are you looking to do, if anything?
Well, I'm looking to finish painting a shed,
Wow.
doing some touch ups on some of the projects that we had. A short, quick little vacation. I'm actually getting down to Phoenix to go visit my brother for a weekend. Real quick trip, fly out
Nice.
Friday, coming back Sunday. So yeah, it'll be good. Looking forward to that time. Don't get to see him as often as I'd like. So
Excellent. Good. Well, enjoy that. Be safe. Hopefully we can travel still given the variant. And
yeah,
again, thank you again and have a good afternoon.
you too. Thanks, Mitch.
All right. Take care. Thanks,
All right,
Matt.
bye,
Bye-bye.
everyone.